Good morning and welcome back to the channel. In this edition, we're going to be diving deep into one of the company which really caught my attention because of its high operating profit margin. And in a capitalistic world, a company which is able to maintain a high operating profit margin and sustain it over a long period of time really catches my attention because it in a capitalistic world, it's a competitive world and it's a um, world where any supernormal profit which arises is quickly eaten up by competitors. And if competitors are not able to eat it, there is something special about the business. um, I really started off really impressed with the business in the way the business is structured, but some of the decisions I think that the management has taken has really caught me off guard. So one of the decisions that the management has taken is that the company. So I'll give a brief overview before diving into what the management thinks. Uh, this company is a, a crane rental company. It is Asia's largest crane rental company, and it is the world's fourth largest crane rental company. It has 346 cranes as of FY24, which it rents to various industries. Windmill being the top industry which it rents to. 50% of its revenue comes from servicing windmills, and providing cranes to windmills. Now, the operating profit margin is hovering around 40 to 50%. There are very few businesses which I can think of, which I've seen, which I've analyzed and rejected or selected. There are very few businesses which I've seen that the operating profit margin is hovering in the range of 40 to 50%. The market cap is close to 3,500, so it hasn't blown up in terms of its market cap. The price to earnings is also reasonable at 19 price to earning. With those numbers, with those operating profit margin, really intrigues me as to why the market has not given it a price which it deserves. So is it mispriced? The question arises: is it mispriced? Now, if you look at the return on capital employed and return on equity, even those are sitting at very healthy numbers. So if we assume the risk-free rate to be 7%, which is the government yield, and weighted average cost of capital or the return that they make on those risk-free rates, the opportunity cost of deploying capital within this business, if you are expecting anyways close to 15%, the capital optimization ratios really seem to suggest that the company has something special going on. But what really caught my attention was the management's view on what the future would look like. So what the management believes is that this is the business we are operating in. Um, and moving ahead, we will get into EPC, which is a lower margin business. And it is guided that 60% of its business would come from something which it has a strong capability of, and 40% would come from engineering, procurement, and construction, which is EPC, which has a lower margin of close to 9 to 10%. Now, that is something which really caught me off guard, and uh, something that is already working well for the company, and the company's management then decides to incorporate something jazzy, is something I did not like. What I also did not like was, within the remuneration that it gives to the board of directors, SEBI has stipulated that there needs to be a certain remuneration over which the company is not allowed to pay that remuneration. But in Sanghvi Movers, for some reason, the company has decided to go beyond that. So if you see here within the key points, you will see one of the key points that there is one of the promoter directors remuneration. The promoter directors pay for the FY24 surpass the limits set by SEBI regulation by 5.1 crore. The excess remuneration has been approved by the board of directors and seeking shareholder approval. So um, really, it's going beyond the rules and seeking special resolution by the directors. Um, these are signs, these are red flags which investors should really watch out for as to before they put in their hard-earned money. In terms of in terms of the way it's structured, so I'll just show some of the price movement that has happened. So Anybody who got into this stock close to 2010, or even right up until, it has remained flat right from 2006 to 2019. It has remained flat, and somewhere around after COVID, it really began to pick up in terms of both the volumes and the price. um, so here, if you quickly analyze some of the key matrices, so the market cap is 3,500. The book value is 234. The price currently is 806. So price to book is sitting at 3.45. So a lot of hardcore value investors might call it expensive, but for a business generating a 40 to 50% OPM, um, minus all the things that I've said about what the management thinks, it looks mouth-watering. But we need to factor in everything, I think, in terms of what the management thinks and where they are headed, what their thoughts are, how are they are deploying capital, are they good capital allocators? A lot of times people are promoted to the CEO positions, and they are in the leadership positions, and they are not great at capital allocation. And in a business like this, where essentially you're sitting on a bunch of cranes, you're renting it out, and then you decide to go into a business which essentially is subpar, a business which you're trying your hand at, because uh, because there is no particular company providing specialized EPC for windmills. So because 50% of the revenue comes from windmills, um, they are catering to their clients in a more broader manner by lowering the margin. I believe it's not a strong or um, a justified move, but the management has other ideas. So here, if you see the profit and loss statement in terms of the sales, 623 crores of business, expenses rocket. So expenses obviously very low because it's a rental company. Operating profit margin sitting at 367, which is a 59%. And this operating profit, as we go ahead, is going to keep decreasing because of the blending of EPC projects, and also the fact that right now the order book is sitting at around close to 430 crore, which is below 1 year's revenue. So really, if the company doesn't start getting order books within its pipeline, there is a panic which is going to be set up amongst the shareholders as to why the company is not able to convert. But as the management has guided, and as I've seen through various interviews that the management has given, they have mentioned that they are in process of increasing that order book, and a lot of them are in pipeline. So we'll have to wait and watch as to what the percentage of order book to the annual revenue is, because that gives a revenue visibility. And also, there have been a lot of macro factors which has impacted the revenue. So the revenue could have been higher. We've had the elections which have resulted in lower crane rental demands. There has also been early onset of monsoon, because of which a lot of sites have gotten impacted. So the crane rentals have been lower than anticipated. So this number was anticipated to be way higher, but wasn't to be because of these macro factors. But that's all right. I think even if somebody is looking at it for the long term, they can see that these macro factors are one off, and then invest accordingly. So here that we see a profit of 252 and a net profit of 187 crore. So on a revenue of 623 crore, it's generating a net profit of 187 crore. A lot of companies, after writing 2,000 crore worth of business, they show an EBITDA profit. So that those are all startups which really go on volumes of revenue and future projections and this and that, but they're not able to show profits in this manner. Like, this manner is staggering in terms of the sales to net profit ratio. So if you quickly see what the price of the shares has done. So if you bought it 3 years back, it has given a compounded annual growth rate of 67%, which is staggering, because for money to double within 1 year, you need a 72%. So within 3 years, your money can literally become 8x. So if you're achieving 72%, one becomes two, and two becomes four. So 4x, sorry. So it has given substantial return, but will the return keep being churned out is the big question, because we are looking at it not from a retrospective view, but from a prospective view, from a prospective pick. So, in terms of a prospective pick, is it a good pick? Do let me know in the comment section. I would love to hear anybody who's done more research on this and has a view on this. Would be really helpful. So if you quickly look at some of the FIIs that are present, so promoter stake is at close to 47.25%, which is below the 50% mark. Public has close to 47%. Some of the notable investors here we can see is Kedar Porgaonkar and Girish Gulati, and see these guys have some of the big stakes. In terms of the FIIs have also have a 2.41% stake, nothing notable, and no FII which has a stake of more than 1% to show. Yeah, so this is a shareholding. So if you look at the notes from the con calls, right? So we've been harping on some of the issues that we said. So it's the EPC business. You can clearly see that the management has started to highlight on the EPC business. Revenue contribution from EPC business expected to grow significantly. So this is what I was talking about. EPC revenue for the quarter increased to around 13.5 crores, and this is now going to keep increasing. What it's saying is that the company has an ability to generate 300 crores of cash equivalent to net debt. Yeah, that's what it's mentioning. It has a capex plan of 250 to 300 crore. And the debt currently sitting on the books is close to 370 crore, with a repayment rate of 9.6 to 7%. So a company which is more stronger and more robust would have a more lower rate of repaying those loans. But right now, the weighted average cost of the loan on the books of Sanghvi Movers is close to 9.6 to 9.7%. All right, that's it from my side on this edition of Sanghvi Movers. Please do let me know in the comment section what you think of the analysis. Any further company that you want me to look at. That's it from my side. Goodbye and have a great day ahead.